Richard Wyckoff was not simply a chartist. He was a forensic psychologist of capital. He understood that the market is nothing more than a giant organized mechanism for the transfer of wealth from the impatient to the patient. He was not teaching you how to draw trend lines. He was teaching you how to read the minds of the largest operators. That is the core thesis of this entire masterclass. You must stop looking at the price action and start seeing the underlying intent. The market is speaking to you in a clear, consistent language, the language of supply, demand, and manipulation. Do you know how to listen? Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. To fully integrate these principles into trading practice, the foundation must be built upon the original wisdom. Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, remains the definitive guide for understanding trading as a serious professional pursuit. This annotated edition by Max Davidson contains the original timeless text, supplemented with clarifying notes to provide context for the modern trader. It focuses heavily on the disciplined use of stop losses, the error of averaging down, and judging the market purely by its own action. The link to this book is in the description below. Most traders only focus on 1/3 of the required structure. They focus solely on the setup, the entry. But the system, the profitable machine, stands on 3 interdependent pillars. Precision entry is the first. Calculated exit is the second. And the most difficult, unwavering management, is the third. If the management pillar crumbles under the weight of fear of missing out or sheer ego, the entire structure collapses. A perfect entry with poor management yields the exact same result as a random entry, catastrophic failure. This brings us to the entity we must track, the ghost in the machine, the composite man. Wyckoff conceptualized this entity as the hidden collective mind of professional operators. The composite man is not malicious but utterly ruthless. He exists solely to absorb the shares of the weak. Every single shakeout, every sudden violent move against the trend is designed to test your internal conviction. It is designed to make you question the system you supposedly trust, because the market knows your weakness. The market is not an external entity to be conquered. It is a perfect, unforgiving mirror of your internal structure. If you are desperate for money, the market will exploit that desperation. If you are impatient, the market will make you wait until you break. If you cannot manage your emotions during a drawdown, the market will reward you with a deeper one. This masterclass is not about memorizing patterns. That is the easy part. This masterclass is about building the internal structure that allows the external system to work flawlessly. The system you are about to receive is logical, mechanical, and statistically sound. But it requires a pilot who is equally logical, equally mechanical, and utterly devoid of self-sabotage. The greatest irony of trading is that the profit does not come from the moment of genius. It comes from the moment of surrender. It comes when you finally accept that you are not smarter than the market, but you can be more disciplined than the majority. You think you need more excitement. You are wrong. You think you need a better indicator. You are wrong. Every time you chase the adrenaline rush, you are paying a hidden tax directly to the composite man. That is the cost of ego. You will never find consistency until you redefine what trading is. It is not a battlefield. It is an assembly line. Your job is to find the setup, execute the entry, manage the risk, and secure the take profit or accept the stop loss. Repeat. The market does not reward brilliance. It rewards boredom. It rewards the mechanical execution of a system you already know is profitable, provided you have the patience to let the statistics play out. This is why the 3 pillars must be robust. If your entry is sloppy, your management will be panicked. If your exit is arbitrary, your management will be ruled by greed. We are here to eliminate the arbitrary. We are here to define the exact points where the composite man is preparing his moves, where he is accumulating or distributing, so that we can step in alongside him, not against him. We will begin by examining the absolute foundation of all market movement. We must first understand how to read the language of effort versus result, and the signal the volume is sending us long before the price confirms the move. If you cannot read the intent, you will always be reacting to the outcome. And reaction is always too late. We begin now with the law of supply and demand, viewed through the lens of Wyckoff's true genius. The engine that drives all price movement is brutally simple: the law of supply and demand. When buying pressure or demand overwhelms the selling pressure or supply, the price must rise. This is intuitive. But the intermediate trader gets stuck because they focus only on the result, the candlesticks, and ignore the intent, the volume. Wyckoff showed us that price is merely the effect. Volume is the true cause. If you see price failing to rally on increasing volume, what does that tell you? It tells you that every buyer stepping up is immediately met by an invisible massive seller. It is the market speaking in a whisper, telling you the demand is being absorbed. The battle is raging, but the price is not moving. This imbalance, this quiet absorption, is the signal you must learn to identify. This leads directly to the second and arguably most psychologically important law, the law of cause and effect. Every market trend, every sustained move must be preceded by a period of preparation. The cause is the period of tedious, grinding price action, the accumulation phase at the bottom or the distribution phase at the top. The effect is the resulting markup or markdown trend. Most traders hate the cause phase. They hate the sideways chop, the volatility that burns premium, the boredom that leads to self-doubt. They call it noise. But this boring period is the invisible work being done by the professional operators. It is the necessary tension coiled before the spring release. If the cause is small, the resulting effect will be small. If the accumulation phase is long, deep, and painful, the resulting markup will be powerful, sustained, and rewarding. The size of the cause determines the scope of the effect. Your patience in enduring the boredom of the accumulation is precisely what determines the magnitude of your reward in the markup. This is why understanding Wyckoff is like walking into a high-stakes poker game knowing exactly how to count the chips and read the tells of the house. You are no longer guessing. To confirm the presence of a genuine cause, we rely on the third law, effort versus result. This law connects volume, the effort, to price movement, the result. When a large amount of volume, massive effort, produces only a small price change, a poor result, it signifies that the existing trend is meeting significant opposing force. The engine is redlining, but the car is barely moving forward. This divergence is the confirmation that the foundational structure is about to fail. Conversely, if low volume produces a massive price movement, it often means the move is not real, or that it is a temporary overshoot, lacking the sustained participation required for a true trend change. These three laws are unified by the concept of the composite man. Stop thinking of the composite man as a secret cabal meeting in a dark room. That is drama, not trading. The composite man is simply the collective, unified force of smart money, the institutions, the professional desk traders, the operators who understand human psychology and exploit its predictability. They exploit the retail traders' predictable fear of missing out and their predictable panic. The composite man does four things, which define the four phases of the trading cycle. First, they accumulate, buying quietly during periods of doubt and despair. This is the painful cause. Second, they initiate the markup, rewarding themselves by driving price higher, drawing in the emotional crowd. Third, they distribute, selling their positions quietly into the rising greed and euphoria of the public. Finally, they initiate the markdown, driving price lower into the inevitable panic and forced liquidation of the masses. The emotional state of the composite man is always opposite to the emotional state of the retail crowd. While the crowd feels despair in accumulation, the composite man feels quiet confidence. While the crowd feels greed in distribution, the composite man feels detached execution. Your biggest psychological obstacle is your own ego, your need to be right. To correctly identify whether the market is in accumulation or distribution, you must surrender your personal prediction and simply read the intent of the composite man based on the evidence of volume and price structure. If you project your desire, if you want the price to go up, you will inevitably misinterpret the action. You must maintain objectivity, treating the market as a mirror reflecting the collective bias, not your personal bias. The greatest error made by the intermediate trader, the one that guarantees they give back all their profits, is confusing a genuine sign of strength with a final sign of exhaustion. They look at a massive green candle and assume the trend is accelerating, when in reality the composite man is throwing the last of their supply onto the market, shaking the tree one final time before the inevitable reversal. This distinction is subtle, often occurring on the same volume signature, yet with profoundly different structural implications. Understanding the precise difference between a true spring that signals the beginning of the markup and an upthrust that signals the end of the distribution is the difference between consistent profit and catastrophic loss. We must now define those specific structural tells. The professional entry is not a guess, and it is certainly not a chase. The critical mistake most retail traders make is attempting to enter during the struggle, the volatile, high-volume churn that defines the accumulation or distribution phase. They see the initial aggressive move off the lows and feel the primal urge to jump on board before the train leaves the station. But the composite man does not place trades based on hope. The composite man waits. Your entry must be placed immediately. After. The struggle is resolved. Resolution means the dominant force, the smart money, has absorbed all available supply or exhausted all available demand, and the market structure has confirmed this exhaustion. We are looking for three precise entry mechanics that define this resolution within the Wyckoff framework: the spring, the upthrust, and the backup to the edge. The spring confirms the failure of sellers to hold the low of the trading range. The upthrust confirms the failure of buyers to hold the high. Both are powerful signs of reversal. But the most common and often safest entry point is the backup to the edge, also known as the last point of support or last point of supply. This is where the market gives you the final, unmistakable signal. This is where we must introduce the concept that separates the professional from the amateur: the test. The market rarely moves in a straight line after resolving a major structural phase. After a spring occurs, confirming that supply has been momentarily exhausted, the smart money needs to be absolutely certain. They need to know if any weak hands, trapped sellers, or opportunistic short sellers remain. So, the market returns. It moves back to the level of the spring or the edge of the accumulation zone, often appearing weak, hesitant, and frustratingly slow. This return is the test. Psychologically, this is the most difficult moment for the intermediate trader. You saw the strong rejection, the high-volume effort that defined the initial move. Now, as the price drifts back down toward your ideal entry point, every fiber of your being screams, "It failed! It's going lower!" You are terrified that the market will break the low, and you will be proven wrong. This is the market's design. It is intentionally engineered to shake out the impatient and the fearful, allowing the composite man to quietly sweep up the remaining supply at the most advantageous price. The test is the final confirmation of the commitment of the smart money. You must wait for it. You must demand it. To validate the test, we turn to volume analysis. This is the market whispering its secrets. The initial move that breaks the prior resistance or support, the move that defines the spring or the upthrust, must occur on high or increasing volume, signifying professional participation and effort. But when the market returns to test that level, the volume must be low. This is the critical signature. Low volume on the test confirms that the large players have already absorbed the supply or demand, and that the remaining selling pressure in an accumulation context is negligible. There is no major opposition left. If the market retests the level on high volume, it is not a test. It is a re-engagement of the struggle. It means the composite man has not yet finished their work, and you must stay on the sidelines. The professional entry only occurs when the volume signature confirms exhaustion on the retest, followed by increasing volume as the price then turns and begins to move away from the tested level. High effort, low response, increasing effort again. That is the sequence. If you jump in prematurely, driven by the insidious whisper of the fear of missing out, you are entering precisely when the market is most likely to violently test your conviction. The market will often spike just enough to trigger your premature entry, only to reverse sharply and hit your stop loss, before continuing on the original intended direction. This is the tax paid by the impatient. Wyckoff demands patience. He demands you wait for the final obvious confirmation that the composite man has cleared the decks. This waiting game also defines the necessary discipline around risk management. Your stop loss is not merely a monetary limit. It is the point at which your thesis is proven incorrect. If you enter after a confirmed spring, placing your stop loss just below the low of that spring, you are stating, "My belief is that all supply has been absorbed here." If the market returns and breaks that low, it means your assessment was fundamentally wrong. It means the composite man has fooled you or that a larger force has intervened. The stop loss must be treated as the instant acceptance of a failed hypothesis. It is not a negotiation. It is not a suggestion. If the stop is hit, the structure has been invalidated, and you must exit instantly and without emotional consequence. The amateur views the stop loss as a painful expense. The professional views it as the cost of gathering new information. The entire methodology of the professional entry culminates in what we call the professional ambush. This is the specific moment where the market is designed to look weak, just before it explodes upward. It is the moment the price is sitting on the confirmed last point of support. Volume is drying up, and the retail crowd is selling their positions in panic. You are positioning yourself precisely where the smart money has decided to launch the markup phase. This is the highest probability, lowest risk entry point available. The professional ambush requires discipline, structural recognition, and the absolute mastery of volume analysis. It is the convergence of price, time, and effort. Once you have successfully executed this entry, however, the job is only half done. Getting into the trade is one thing. Staying in it and knowing exactly when and how to extract maximum value is the true test of the trading psychologist. Because the market will now attempt to shake you out of your profitable position through complex manipulation and emotional warfare, demanding precise management mechanics that must be defined well before the trade ever moves into profit. This brings us to the most difficult psychological battlefield in all of trading: the exit. The entry is excitement fueled by possibility. The exit is confrontation. It forces you to exchange the intoxicating fantasy of infinite gains for the cold, hard certainty of realized profit and loss. That certainty terrifies the ego. Most traders struggle here because they confuse a trading position with a deeply held belief. To exit, either for profit or for loss, means accepting that the market is finite and that your participation in that specific move is over. When we approach the profit exit, we must quantify the fantasy. This is where Richard Wyckoff's foundational principle of cause and effect becomes your primary profit target calculator. You determined the cause, the accumulation range in phase 2. Now, you must calculate the minimum expected effect. The accumulation range is measured in units, in points, in time. This measured cause gives you the minimum required energy for the subsequent move. Your profit target should align with the structural level that satisfies this measurement. It is not an arbitrary number. It is a mechanical calculation based on the energy expended by the smart money during the base building phase. But the market rarely stops exactly where the minimum effect is satisfied. You must look for the signs of market fatigue, the whispers of distribution or redistribution beginning at higher prices. Look for wide price spreads on high volume, yet with little to no upward progress. The price is moving, but the professional selling pressure is absorbing the buying interest. That is the time to extract the value you earned. This brings us to the critical psychological necessity of partial scaling. The amateur holds the entire position, praying for the absolute peak, chasing the last penny of profit. The professional scales out, taking off 1/3 of the position at the first major resistance or the minimum cause and effect target is not about maximizing returns. It is about minimizing psychological risk. The moment you realize a portion of the profit, you have locked in certainty. You have paid yourself. This simple act shifts your entire mental state from hopeful speculation to secured management. You are now playing with house money, and the remaining position can be managed with far greater patience and objectivity. You sacrifice the potential for the absolute maximum return in exchange for mental resilience, which is a far more valuable commodity in the long run. This mechanical act inoculates you against the market's inevitable attempts to shake you out. When the inevitable pullback occurs, the trader who has already scaled out feels relief. The trader who is still fully exposed feels panic and often gives back all their paper gains. Remember, uncertainty is the enemy of consistency. Realized profit is certainty. Now let us turn to the loss management exit. This is where the true character of the trader is forged. The stop loss is not a symbol of defeat. It is a necessary cost of doing business. You must treat it not as a failure, but as maintenance cost. Every system requires maintenance. The stop loss is the predetermined price you pay to keep your trading system operational for the next opportunity. The professional accepts the loss instantly, mechanically, without emotion. The system said exit, so the exit is executed. The amateur argues with the market. He looks at the stop loss level and says, just a little further, or it must turn around here. He pleads with the price action, believing his opinion holds more weight than the capital he is risking. This argument is the slippery slope into ruin. The cardinal sin, the ultimate act of surrender to irrationality, is moving a programmed stop loss further away from the entry. The moment you execute this move, you have not just changed a number. You have broken the covenant with your system. You have destroyed your calculated risk-reward ratio, annihilated your expected profit factor, and signaled a complete surrender to irrational hope. Hope is the most expensive emotion you can trade with. When you move that stop loss, you are not protecting your capital. You are protecting your ego's need to be right. You are sacrificing the integrity of your entire future system for the temporary comfort of avoiding a realized loss. The emotional consequence is devastating. You turn a small, acceptable maintenance cost into a devastating, system-breaking event. You prove to yourself, trade after trade, that rules are optional when the pressure is high. And once rules become optional, consistency becomes impossible. The paradoxical wisdom of this phase is undeniable. The ability to take a small loss effortlessly is the single most important skill separating the consistent trader from the gambling addict. The loss must be accepted with the same indifference as an insurance payment. It is the cost of staying in the game. Now ask yourself honestly, look deep into the mirror of your trading journal. Do you truly fear losing money, or do you fear being wrong? The market understands human psychology perfectly. It knows that the fear of being wrong, the assault on the ego, the perception of incompetence, is a far more potent and exploitable weakness than the simple fear of losing capital. Losing capital hurts the wallet, being wrong hurts the identity. And the market will exploit that ego. It will tease you back into the trade after stopping you out, just to confirm your initial fear of being wrong. It will manipulate the price right to your moved stop loss, only to reverse violently against you. This is the ultimate test. recognizing that your job is not to be a perfect prognosticator, but a rigorous manager of risk. The professional understands that the market is always right, and the ego must be surrendered at the door. If you can master the art of the exit, defining your profit target with Wyckoff's calculations and accepting loss as a simple business expense, you have solved 70% of the trading puzzle. But the mechanics of entry and exit are useless without the third pillar, the calculation of position size that allows you to weather the inevitable volatility and compound returns with mathematical precision. That is the final mechanic we must master, the art of compounding capital without risking annihilation. But the mechanics of entry and exit are useless without the third pillar, the calculation of position size that allows you to weather the inevitable volatility and compound returns with mathematical precision. That is the final mechanic we must master, the art of compounding capital without risking annihilation. The concept of risk per trade, often shortened to R, is the single most important variable you control in the entire trading process. R is not a static dollar amount. It is a fixed, non-negotiable percentage of your total trading equity. This is the first rule that separates the gambler from the professional. Risk must be constant relative to your account size. If your account grows, your dollar risk grows, but the percentage remains anchored. Why this rigidity? Because the market is designed to test your limits. You will experience drawdowns. It is mathematically guaranteed. If you allow your emotional state to dictate your risk, increasing it after a win or panic, reducing it after a loss, you enter a death spiral of emotional trading. Risk. Per trade, or 1R, is the quantum of pain you agree to absorb before the trade even begins. It is non-negotiable. Stop treating your capital like water in a leaky bucket. We often talk about the 1% or 2% rule as if it were merely a conservative measure. It is not. It is a fundamental survival mechanism. Consider the mathematics. If you risk 1% per trade, you need 100 consecutive losses to wipe out your account. If you risk 10%, you need only 10. No system, no matter how robust, is immune to a streak of 8 or 9 losses in a row. The 1% rule is your insurance policy against the inevitable statistical anomaly. It forces you to treat the market as a game of probability, not destiny. Your job is not to predict the next candle. Your job is to survive the next series of inevitable losses so that you are still capitalized for the winning streaks that follow. Most intermediate traders struggle here because they confuse patience with lack of conviction. They want the rush of a massive win, forgetting that a massive win only matters if you haven't already destroyed your foundation. The market doesn't reward bravado. It rewards mathematical discipline. Once R is defined, let's assume 1%, the next step is the mechanical calculation of position size. This is where most retail traders fail, using arbitrary unit sizes instead of precise measurement. Your position size is determined by 3 variables: your fixed risk percentage, 1R, your total account equity, and the distance between your entry price and your initial stop-loss price. The formula is simple and must be executed flawlessly before every entry. Account equity multiplied by fixed risk percentage, divided by the distance to the stop-loss. This calculation tells you the exact number of units or contracts you can purchase while ensuring that if the trade hits your stop-loss, you lose precisely 1R and nothing more. The distance to the stop-loss is the critical input. If your technical setup requires a wide stop-loss, your position size must shrink dramatically to maintain that fixed 1R value. If your setup allows for a tight stop-loss, you can increase your position size. You are not risking more money. You are simply adjusting the leverage to ensure the risk remains constant. The only disciplined way to increase your position size is through pyramiding or scaling in. This is strictly prohibited until 2 conditions are met. 1, the initial position has moved far enough into profit to justify relocating your initial stop-loss to the break-even point or better. 2, the market structure confirms the continuation of your initial thesis. When you add to the trade, you are not committing more capital from your account. You are using market money, the unrealized profit you have already captured. By moving your stop loss to break even, your original 1R risk has been entirely removed from the trade. Any subsequent scaling in then uses the market's generosity as collateral. This dramatically changes the psychological landscape. You are no longer trading with fear. You are trading with controlled aggression. It is how you turn a standard winning trade into a portfolio-altering trade, but you must never chase, only reinforce. Just as important as scaling in is the systematic approach to scaling out or profit-taking. The amateur trader holds the entire position until the final target, risking the emotional devastation of watching a massive profit evaporate. The professional defines specific technical levels for partial exits. This is not about maximizing every single price fluctuation. It is about maximizing psychological stability. You might take 25% off at the first major resistance level, securing the initial 1R profit. You take another 25% off at the second level, locking in the bulk of the move. Each partial exit locks in capital and reduces the mental burden of the remaining position. This reduction of pressure allows you to practice the highest form of market discipline, inactivity. Position management often means sitting still for days, sometimes weeks, while the market grinds toward your final target. The trade is managed, the risk is removed. Now, the market must do the work. Your greatest challenge is often the urge to interfere. Patience is not passive waiting. It is active, disciplined stillness. This fixed 1R approach is the secret weapon of the successful large-scale institutional trader. They are not inherently smarter than you. They are simply better capitalized and less emotional. By consistently risking 1R on every single trade, they treat the market not as a series of destiny-defining moments, but as a distribution curve. They know, mathematically, that if their edge has a 55% win rate and a 2-to-1 reward ratio, the outcome is guaranteed over a large sample size. The fixed 1R ensures that the inevitable losses are statistically insignificant, while the winning trades, when scaled, deliver exponential returns. They are not aiming for perfection. They are aiming for statistical consistency. When you adopt the 1R discipline, you stop being a trader hoping for a win, and you become the house, the casino, which knows the odds are in its favor, provided the rules are never broken. This shift from predicting to managing probability is the final barrier. It is the moment you stop seeing the market as an opponent and start seeing it as a predictable machine. We have defined the entry, the exit, the risk, and the management. But all these mechanics hinge on one terrifying invisible factor: the internal story you tell yourself when the market turns against you. How do you maintain this rigid discipline when the fear of loss is paralyzing your decision-making? The true masterclass is not in the chart reading, it is in the mastery of self. We must now turn inward and confront the ego. We talk about execution, but execution is just the visible symptom. The moment you define your entry, your exit, and your risk, the system is fundamentally complete. Any deviation after that point is purely psychological. The market does not care about your intelligence, your bills, or your hopes. It is the perfect, cold, unbiased mirror. What you see reflected in your profit and loss statement is not the market's behavior. It is the absolute truth of your discipline, your patience, and your internal anxiety. The Wyckoff method, or any structured system, is powerful because it gives you objective rules. But the moment you feel compelled to break those rules, the system exposes your personal flaws under pressure. Take over trading. It is never a technical necessity. Never. The chart does not suddenly demand that you must be in a trade right now. The need for constant action stems from a deep internal anxiety, a fear of missing out, or worse, a desperate need for external validation. You trade because you need the market to tell you that you are smart, that you are relevant, that you are worthy of success. This is a fatal mistake. Trading is a solitary, quiet act of probability management. If your strategy requires you to be busy, your strategy is broken. If your mind requires you to be busy, you are broken. And then there is the ultimate ego trap: revenge trading. A loss is accepted by the logical mind, but the ego screams betrayal. You feel personally insulted by the movement of price. You take that loss, and instead of walking away, you enter a second trade, often larger than the first, often without a proper setup, attempting to force the market to validate your intelligence. You are trying to prove your superiority to a probabilistic machine. It is impossible. The market has no memory, no malice, and no ego. Only you do. This is all rooted in the illusion of control. We are managing probabilities, yet we try desperately to manage outcomes. We cling to the hope that this trade will save us, that this one move will erase the mistakes of the past week. Mastery is the paradoxical surrender of outcome control. Your job is to focus solely on the quality of your execution, your risk management, and your setup adherence. Everything else is noise. Now let's talk about discipline, the foundation of that surrender. Trading discipline is life discipline distilled and applied under extreme pressure. If you cannot manage the small things in life, your sleep schedule, your diet, your commitment to exercise, or your consistency in relationships, how on earth do you expect to consistently manage a highly volatile, high-stakes profit and loss statement? If you cannot manage yourself away from the screen, you will never manage yourself on the screen. This is why the trading journal is the most important tool you possess, far more valuable than any indicator or algorithmic model. You are not just logging the entry price and the profit factor. You must log the feeling. What was the tension level in your chest 10 seconds before you hit the buy button? Were you angry? Were you bored? Were you experiencing a fear of missing out? Identify the psychological triggers that lead you to deviate from your system. The system didn't fail you. Your emotional state caused you to fail the system. The true path forward is the stoic approach. Focus only on what is within your control: your preparation, your risk size, and your execution. Accept what is not within your control: the direction of the market, the news events, the final outcome of any single trade. The market is not fair. It is simply a mechanism of supply and demand. Your only duty is the impeccable execution of your predefined plan. When you step back and look at your entire trading history, the only variable that truly changes is you. The chart patterns repeat. The fear repeats. The greed repeats. Most traders spend their entire careers looking for the perfect indicator when they should be looking in the mirror. They spend thousands on courses but refuse to spend 5 minutes journaling their own fear. This is the final, brutal question, and you must answer it honestly, right now. If you lost everything tomorrow, every dollar in your trading account, would you blame the market, or would you finally admit that you were the variable that broke the system? The choice defines your ceiling. We have confronted the ego. Now we must build the mechanism for consistent, unemotional execution. We have confronted the ego. Now we must build the mechanism for consistent, unemotional execution. This full system, this architecture of professional trading, rests on 3 non-negotiable pillars. First, the Wyckoff philosophy, seeing the market not as chaos, but as a structured auction. Second, mechanical execution, the inviolable rules of entry, stop loss and take profit. And third, psychological discipline, the shield that protects the first 2 from the noise of your own fear and greed. But here is the profound, counterintuitive truth that separates the professional from the perpetual gambler. To achieve true, lasting freedom in the market, you must first become a slave to your own rules. This is the paradox of mastery. You seek independence, yet you must submit entirely to the discipline you designed. You yearn for excitement, yet the path to wealth is relentlessly, excruciatingly boring. That boredom is the metric of your success. If you are consistently bored, you are consistently executing. The intermediate trader chases the massive, life-changing win. The professional understands that wealth is built not in explosive gains, but in the relentless compounding of small, boring, statistically sound edges. The small gains compound into wealth only when the system is inviolable. When you stop treating trading like an exciting hunt for profit and start treating it like a quiet, methodical business operation, paying strict attention to your risk capital, your profit and loss, and your daily operating procedures, that is when the transition to the professional mindset is complete. The market doesn't care about your intelligence. It doesn't care about the hours you spent studying Wyckoff charts. It only cares about your patience and your willingness to follow your own map. Most traders confuse a profitable trade with a good trade. They win money on an impulsive entry and reinforce a terrible habit. They lose money on a perfectly executed setup and immediately abandon the strategy. This is the ultimate trap. You must sever the emotional connection between the outcome and the quality of your execution. Did you follow the signal? Was your stop loss placed according to the plan? Was your position sizing correct? Yes or no? The quality of the execution is the only thing you control. The outcome is statistically predetermined over a large sample size. The goal is to execute the perfect trade, knowing that the immediate outcome is irrelevant to the quality of the execution. Let that sink in. This path demands solitude. Trading is not a team sport. It is a quiet war against the reflection in the monitor. You are the general, the soldier, and the enemy all at once. The only way to win is through the relentless application of discipline, even when the market is trying to lure you out of position with the siren call of fear of missing out. We have provided the blueprints, the method for understanding the forces of supply and demand, the structure for mechanical execution, and the psychological framework for maintaining equilibrium. The system is now complete. But the final secret, the one that governs the entire operation, is this. The market doesn't care about your intelligence. It only cares about your patience. Patience to wait for the perfect setup. Patience to hold through the necessary drawdown. Patience to let the system work without interference. We have now provided the blueprint for the patient professional, but the blueprint is merely paper. The execution is the only thing that matters. As the great philosophers of the markets once said, if you have discipline, you have the market. If you have no discipline, you have nothing. The foundation is laid. Now we must transition to the ultimate measure of success. Not the dollar value, but the sustained structural integrity of the business model itself. The question remains. Are you ready to stop being a trader and start being a proprietor? To fully integrate these principles into trading practice, the foundation must be built upon the original wisdom. Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, remains the definitive guide for understanding trading as a serious professional pursuit. This annotated edition by Max Davidson contains the original timeless text, supplemented with clarifying notes to provide context for the modern trader. It focuses heavily on the disciplined use of stop losses, the error of averaging down, and judging the market purely by its own action. The link to this book is in the description below.